Hi Simon, hi Nick, nice to see you both. What a month, there's just so much going on. Never a dull moment in finance, hey?
No, it certainly isn't. Excited to be here.
Yeah, it's been a busy couple of weeks for us. Earnings season's over, but there's still loads happening in the market.
Yeah, lots to talk about today. So we've gone from this really strong 2024. We had that particularly strong finish after the election of President Trump. We had record highs for markets in February. And now all of a sudden it feels as though markets have dropped. We're in correction territory, which means markets are down 10% from that record high. So Simon, what do you think is the main cause of this?
I think it's been kind of particularly uncomfortable for European investors. It almost kind of feels like a sort of rewiring of that kind of post-World War II order layered on what's been this kind of pretty sharp correction in markets. So we've had the Mag 7, Russell 2000 down 20%, S&P, which is the main index, down 10. So yeah, it's been a difficult time, although the UK's done much better.
And obviously a lot of this is caused by tariffs and DOGE over in the US.
Yeah, so I think there's three reasons really behind this. Number one, tariffs and the uncertainty. And I think we said in our newsletter at the beginning of the year that we expected this year to be volatile. I didn't think we quite expected it to be as volatile as it's been,
yeah,
but
we're
right.
getting
used to President Trump and just a completely different way to sort of govern. And obviously he's kind of set himself up to be kind of global CEO, so it has kind of more meaning. But it's really about uncertainty around tariffs, DOGE, which is the Department of Government Efficiency, and all that kind of uncertainty, I think, is kind of playing into question marks about the shape of the US economy, particularly later on in the year.
Let's get that NASDAQ composite chart on the screen then.
Yeah, that's quite an interesting one. So you can see from this is that not only is it down sort of fairly sharply from the peak, but we're actually now kind of under where we were pre the presidential election. So the Trump bounce has been completely unwound here.
And what about company earnings or profits? So obviously markets have come down. Have we also seen a deterioration in how well companies are actually doing behind the scenes?
We've seen a little bit of deterioration in earnings estimates for this current quarter. We've yet to see anything really transpire later on the year. And Nick, you maybe want to sort of comment on this, but I think I'm talking about the S&P here. I think we're still looking for kind of earnings consensus about 10% up this year, but it's coming from a slightly lower base than it was beginning or end of last year. There is a little bit of nervousness, but I think it's the kind of uncertainty around if you're a CEO, CFO, you don't really know what tariffs or DOGE are going to do to your bottom line. So I think there's a lot of decisions that are potentially being put on ice here, and I think that's just kind of complicating, and as I said, just kind of creating an element of kind of uncertainty.
I think that's key. It's about business and consumer confidence and the impact that's having on potential spending. So if businesses don't feel confident, they don't invest in new equipment, and that flows through to earnings estimates. And the same on the consumer side. We've seen a number of consumer-focused companies coming out and saying that they aren't seeing the level of spending that they had expected, and that's driven by a lack of confidence given this uncertainty.
There's been a lot of layoffs across kind of federal agencies, and that's kind of plainly having a kind of impact on, as you're saying, Nick, consumer confidence. And there's been some really interesting surveys from coming out of the US in the last few days, and we've seen a spike in nervousness around US consumers about their job security that we haven't really seen in recent years. So yeah, plainly this kind of broader level of uncertainty is starting to have an impact. And I think just kind of one sort of final thing on that, the epicenter of this has obviously been the US market. I think this is also coming on the back of what were fairly full valuations for the US market, rightly so, because the US has been the primary source of growth really since the global financial crisis. But I think when you add this kind of layer of uncertainty onto what has been sort of a more kind of toppy valuation, we've obviously ended up with a pretty sharp correction.
Let's go back a bit. So Nick, you talked about falling consumer confidence. Simon, you talked about job losses, and this might make people think of recession. And actually this is a word that really incites a lot of fear in people. But really it just means 2 consecutive quarters of falling output. It doesn't have to be particularly catastrophic. It could just mean the economy shrinks by 0.1% one quarter and 0.1% the next. That happened with the UK in 2023, and actually the stock market was relatively resilient. So what do you think about the current situation? Do you think we're heading for a US recession in particular?
For me at the moment, it still feels like more a growth scare. I mean, the problem is we're not really going to know until we get into the kind of second half of the year, because we've got this kind of almost a kind of freezing of decisions, I suspect, around a whole multitude of different things. And I think it really depends upon really how long this lasts for. I think if the US were to go into recession, I think kind of two takeaways from my perspective is that we probably would see a little bit kind of more weakness in the market. And I think it would be inevitable that the rest of the world would probably follow suit. I think it would be pretty extraordinary to see the US economy kind of go into recession and not have an impact on a kind of wider level. But at the moment, it's not my kind of base case that we do see a recession. It still feels like more of a growth scare.
Good, reassuring. So let's talk about American exceptionalism. For quite some time now, it's felt like the US is really the only game in town. And if we look at our preferred global benchmark, which is the MSCI World, back in February, that had a 72% allocation to US equities. And that was really because American companies are the biggest and the best in the world. Earlier, you mentioned that perhaps European economies and companies might be starting to recover a bit. Do you think it's the end of this?
First of all, I'm not a big fan of the word American exceptionalism because it kind of sounds like everyone else is unexceptional. US leadership in technology isn't altered by kind of what we've seen over the last couple of months. I mean, you could argue that I think China is kind of further up the curve than I think we thought they were. We've had DeepSeek, we've had kind of news, Nick, that you were pointing out last couple of days ago with kind of BYD and their kind of charging breakthrough. But I think there's no doubt in my mind that the US has still got leadership in AI and technology. I think the interesting thing for me is that, Trump's actions here, whether they sort of shake Europe out of its kind of malaise. And I know I'm kind of thinking kind of very long term here, but it's worthwhile kind of remembering that US tech leadership has effectively grown out of their kind of military power and their military might, particularly coming out of World War II. And I was reading HP, one of the sort of, I guess, the kind of poster childs originally of the kind of tech sector. They produced radar systems, back in the kind of early 50s. So I kind of wonder whether we might just look back on this kind of point where, we kind of find out that President Trump inadvertently started to make Europe great again, but we shall see.
This mega becomes mega, make Europe great.
Exactly.
You can see the impact in the defence sector where President Trump backing away from NATO should have ended up being positive for the American defence companies because they could sell more to Europe, but his actions over Ukraine and sort of the idea that Europe needs more sovereignty over its own defence has actually meant that it's going to probably be negative for the US defence companies and more positive for the European ones. It's going to end up increasing the European industrial base through, a desire to not be as reliant on the US.
Yeah, and I think there's kind of one also sort of overriding theme or kind of position here is that, what we're seeing with DOGE in particular are fiscal cutbacks in the US. And that's completely at odds with kind of what you're seeing in Germany now, where you've got fiscal expansion, exempting defence expenditure and from their sort of debt rules. I think is almost a kind of seminal moment. That's, in my view, probably positive for Europe as a whole.
Yeah, it's been an amazing turnaround in European equities in just a few weeks.
Yeah, thankfully, we are underweight US in the MSCI. But I think this is a kind of interesting moment in time.
So we've talked about a few investment themes so far. Nick, head of equity research, obviously you spend a lot of time analysing different sectors, different companies. What are you looking at in particular at the moment?
I mean, I think this volatility and uncertainty in the market hasn't really changed the fact that generative AI has come along and is, it could be one of the biggest sort of inflection points that we see for the last 50 years, as big as smartphones have been or the advent of the internet. And really what this is about is that computer systems have previously been about retrieval of information that already exists. But generative AI means a computer system becomes about creating information and content basically as it's needed. And the implications of this for productivity within businesses are immense. And the next wave that we're seeing now is agentic AI, which is where the AI has agency. It's able to take information and plan and make decisions and actually act like a virtual employee. We also would expect the next stage after that to be sort of physical AI, basically where AI becomes capable of understanding and interacting with sort of the 3D physical world. It understands inertia and friction, it understands object permanence, and this will enable far better robotics to be created. So humanoid robots capable of replacing physical workers. So we'll have virtual new workers and physical new workers with humanoid robots. And this will help to alleviate some of the pressure on sort of skilled labor and those jobs that humans don't want to really do anymore in the developed world.
And if I could just kind of add to your kind of point there, Nick, about this kind of productivity boom. And I think, if you look over the course of history, when we've seen these kind of productivity booms before, they normally result in supernormal stock market returns. So, you don't get kind of caught up with the short-term noise, because the kind of bigger picture here, I think, is still pretty positive.
That's key, is that the volatility is sort of overshadowing that long-term productivity improvement that's likely to come out of this.
Yeah, and talking about previous productivity booms, are you thinking about the Industrial Revolution and things like that?
Going back to the end of the Second World War, we had the sort of interstate highways and motorways in the UK. That triggered a productivity boom. We had a personal computer, 1982, I think. And then obviously we had the kind of internet. And each of those kind of three periods triggered quite an uptick in productivity. And I guess no surprise, we saw those supernormal gains in productivity. I think the other kind of really interesting area for me, aside from kind of technologies, financials, amongst all the sort of kind of concern around tariffs and Ukraine and kind of everything, I think one of the things that I think is we're starting to see is a kind of rollback in some of the regulation that's kind of been put in place kind of post the financial crisis, and I think that should be good news for certainly the banking sector. I guess the kind of particular area that I'm interested in is the sort of M&A side of things. So we've got 1,400 privately held unicorns. These are businesses, startups with a market capitalization of more than $1 billion. 1,400 of those in the world right now. Private capital, the market of private capital has kind of plainly got a lot more sophisticated, but there's going to come a point where we're going to see some exits, and these companies are going to start coming to the market. So we saw 6 tech IPOs in 2023, 9 in 2024. So been a complete dearth of quality IPOs. I think somewhere between 15 and 25 are expected this year. But it was interesting. We saw Alphabet last couple of days make a move on Wiz, which is a cybersecurity company. And I just wonder whether this is the start of a real sort of pickup in kind of M&A activity. We've had a change in FTC Commissioner Lina Khan, who was pretty much putting a stop to anything, and it feels like the kind of shackles have been taken off there. And if that is the case, it's going to be very good news for the big banks, JP Morgan, I guess Goldman Sachs as well. JP Morgan's on 12 times, trading kind of broadly in line with its 5-year average, 2 times book. I mean, to me, these are great businesses that have come down quite a bit in this kind of recent shakeout, but I think look pretty well positioned in a kind of world that I think is going to see quite a bit more deregulation.
Yeah, it's nice to see quite a turnaround here, because financial services have just been so out of favour since 2008 financial crisis, and this is the first time, I think, in my working life that I've seen a bit of interest in the sector, so it feels quite positive.
Yeah, I mean, I think it's deregulation of the wider economy, but also the banks themselves are probably likely to face some deregulation. Maybe some of the more onerous capital requirements get watered down, and it becomes easier for banks to sort of engage with customers in different areas and to lend again. So, I think it could be on both sides, both on their customer side and the banks themselves facing.
And I think coming back to your point about AI, Nick, I think, one of the things that we have been looking for, obviously the kind of focus at the moment's been on the enablers, businesses like NVIDIA that really at the kind of epicenter of the AI revolution, but the kind of almost the more interesting element coming down the tracks are those businesses that are able to utilize AI to make themselves more efficient and more productive. And I think banks are going to be, I suspect, at the kind of leading edge of that. These are businesses that are labor heavy, labor intensive, employing a lot of expensive people. If a lot of that can be done with AI, that should be pretty significant for those businesses going forward.
Also businesses with large amounts of proprietary data And I mean, data is the feedstock for AI. The more data you have about your customers, about your processes, the better the AI, the generative AI that you can build.
Yeah, so no matter what the market's doing, there's always some good stock ideas.
Exactly.
Let's have a look at end of tax year. So obviously that's coming up. 5th of April is the last day of the tax year. So I think we really need to be speaking to clients about all the allowances that they have to use, otherwise they lose them. So things like the ISA allowance, anyone can put £20,000 into an ISA this tax year. Capital gains allowance, that's £3,000 per person. And actually, when the markets come down, it's almost quite a good time to use that because you can sell something, buy it back in your ISA, and you've crystallised a smaller gain on the sale, but you can still own the stock in the ISA.
That's a really interesting point. I mean, obviously, we've talked about the US quite a bit here because that's the sort of epicenter of really what we're seeing market-wise at the moment. But you're absolutely right. The government here is under quite a lot of pressure, and I think plainly the spotlight's going to be on sort of allowances that retail investors have. So I think use it or lose it. As you say, there are some very attractive allowances out there, and I think particularly given the kind of pullback we've seen in markets, I think it's absolutely a kind of great time to be ensuring that you fully utilise those allowances.
Yeah, we've got the spring statement on the 26th of March, so we don't know obviously what's going to happen there, but there could be some changes to allowances. So from my point of view, it makes sense to use the
I think
change.
Difficult to second guess, but I kind of would be amazed if these allowances are going to expand.
So we've talked about quite a lot there. Simon, do you have any final words of wisdom or words of reassurance for us?
As we wrote in our newsletter, we said 2025 was going to be volatile. This to me feels like a sort of normal drawdown that we see in markets generally. So certainly no reason to get kind of overly cautious at this juncture.
Yeah, I like that slide you showed us earlier with the different corrections of the market. Should we get that up on the screen?
This is quite an interesting one, and I think what's caught people out this time is the speed of the correction. So actually, if you go back 75 years, this is the fastest 10% decline we've seen in the S&P over that 75-year period. If you look at the follow-on performance over 3 months, 6 months and 12 months across the space, it's positive. And in fact, over 12 months, the median return of those fastest declines is actually just slightly north of 20%. So don't get panicked, just kind of have that kind of focus on the kind of longer term.
Yeah, and what about that stat you mentioned about missing the 4 or 5 best days of the market? That was quite compelling, I thought.
So if you kind of over 2023 and 2024, we had kind of 20% plus years in the S&P. If on each of those years you'd missed the 10 best trading days, your annual return would have dropped to 4%. So it's kind of so natural human instinct really to sort of see all this kind of uncertainty in the world, not just economic, but politically and kind of geopolitically, is to kind of think, look, I just kind of want out. History tells you actually the worst thing you can possibly do, because markets tend to recover pretty quickly. And as I said, if you happen to be out of the market for those kind of 10 days, it can have a really significant detrimental impact on your kind of total return.
The key thing is that over a long period of time, the market follows earnings. So these short-term periods of volatility don't change that long-term chart of earnings drive stock performance. And I mean, that's the whole basis of our sort of investment approach in equities, is that we want to buy quality companies that play to some secular growth theme, so some long-term growth driver, at a reasonable price. We want to hold them for a long time. So we're not buying companies to hold for a short period. We want to hold companies for a long period of time, and that's the way you've got to look at the market.
You're absolutely right, Nick. I think really what we're trying to be here is shareholders rather than short-term traders. Trading is very, very difficult. If you're out the market for those 10 days, it can have a significant impact on your kind of total performance, not just over a kind of year, but over a longer period of time.
Yeah, and I think in my discussions with clients, I've been saying, you shouldn't need to be worried if you've got the right strategy in place. And obviously these sorts of market corrections, they feel so horrible while they're happening, but actually they're very, very common, they're very, very normal. And to clients, I always say, think about the Killick & Co. 3-pot approach. So we always say, have a think about what you would normally spend in 3 to 6 months, try and have that amount in cash as your kind of emergency savings, then have a think about any sort of abnormal expenditures coming up in the next couple of years, have that in something safe, be it cash, be it government or corporate bonds, and then anything over and above that, that's where you can afford to take the risk and potentially be in the equity market. So you should never have to sell out of that pot of money while the market's down. So that's the advice that we do give to all of our clients. But the main thing I think is the market has recovered from every single crash that's ever happened, and we very much hope that will happen again.
Yeah, and we don't think this is going to be a long-standing crash. I mean, just kind of final kind of thought from me, the sort of best advice I was ever given is that, just remember that, volatility is the price you pay for long-term wealth creation. Yes, you get these kind of drawdowns in the market, which are completely normal, but over the longer run, markets compound at kind of 10%-ish. To kind of sum it up, panic's never a good strategy.
Yeah, absolutely. I like that quote. It is uncomfortable while it's happening. It's all very, very normal. But obviously clients can call us at any time to talk about any concerns they might have.